A lot of our clients come to us with a loan amount that they think they can afford without considering the assessment rate because they either don't know about it or they're just not being considered. So can you talk to us about what an assessment rate is and the appropriateness of one?
Yeah, absolutely. So the assessment rate, simply put, is additional interest rate that's placed on top of the rate that the bank intends on providing you for the loan. The reason why they do that is to stress test the loan, in that if interest rates do rise, which is exactly what's happened since May last year, that your income levels can still cover the loan in that event. And so if they hadn't have done that, we would have seen a lot more people now in a lot of loan stress. So it's really important and prudent for financial institutions to actually put an assessment rate on. What you could argue though is that when you're nearing the top of, or perceivably nearing the top of the interest rate cycle, whether or not it is necessary to have an additional 3% rate margin put on to that passing rate. Now rates could continue to climb, and there's a lot of discussion about that top of that rate cycle coming near. So potentially, there might be a change with the regulator's position on an assessment rate, but at the moment, when calculating how much you can borrow, that additional 3% is very much still applied.
And what do you think is the likelihood of the assessment rate being dropped from 3% to, say, 2%?
Well, we did see a couple of years ago, it increased from 2.5 to 3%, and that was to deal with certain events in the market at that point in time. So it's possible that it can be reduced again, and it may be reduced again. It really will come down to, I suppose, where the regulator thinks the overall market is and the quality of credit that's actually out there at the moment.